It's time for Wise Money with Korhorn Financial Group with certified financial planners Kevin Korhorn, Mike Bernard, and Josh Gregory.
Welcome to another episode of the Wise Money Show with Korhorn Financial Group, where every week we're helping you take your next wise step in your financial life. Thanks for being here, friends. My name is Mike Bernard. I'm your host. I'm also one of the CFPs on the program. With me in the KFG studios, my business partners and fellow CFPs, Kevin Korhorn and Josh Gregory.
How should you structure your investment portfolio if you're planning to retire in the near future? Now, it's obviously been a challenging year in the financial markets, and if you're planning to transition away from a steady paycheck and into retirement, it's even more important that you have the right investment mix so that you can retire with confidence. How should you invest if you're retiring soon? We're helping with that and more this hour.
Yeah, if you're retiring right now, there's great uncertainty. And people are lacking confidence in financial markets, bond market, all that sort of stuff, in the Fed, right? How can you retire with confidence and structure your investments to support that? We're going to help you with that on today's program. If you have a question or needs, we're here to help. You can call or text us, 574-222-2000. That's 574-222-2000. Online, wisemoneyshow.com. Learn a lot more about the show, the firm, and reach out to us with questions there as well. And then all over social media, wherever you're at, we are there as well. Search the Wise Money Show. You can engage with us that way as well. I think I've asked this question before. Answer it yourself, but I'm going to ask you. During a year, when do you think most people retire? Like in a given year?
The time of year.
Yeah. What do you think? I looked. I can't find any data on this. I'm sure someone
Really?
can find it. Yeah.
Oh, I thought you knew the answer.
I don't.
Okay,
So this is opinion time?
Yeah.
I think I might have.
Okay, what you
Like
got?
the real answer?
Yeah. This is anecdotal evidence. A lot of times people retire in either February or March
Because they're getting a bonus from the prior year?
because the benefits reset. And so they say, hey, look, if I'm getting paid vacation or whatever I'm getting, I'm going to get it. And then I'm going to hang in there, get it, and then I'm gone.
I thought you were going to say endure one last cold winter, and then I can retire in the spring. Things are new, and I'll have a summer to look forward to, and then we'll plan what we're going to do next fall and winter. That's
I've observed
Midwestern
that.
thinking.
Yeah, a lot of people around here will retire, especially if they have any kind of lake property or some sort of summer fun that they're used to. They'll retire at the beginning of summer.
I have another proposition.
Okay.
How about this? Very on or very close to a particular birthday.
Yep, that's the one that comes to my mind the most.
Here's
Which is obviously all over the year.
Here's my guess. A Sunday night. Because people like I've told people, just listen, we're going to plan for your retirement. You're going to make a great decision, but you just can't choose a Sunday evening. After noon on Sunday, you can't choose, hey, this is it. Because no one wants to go in.
Going in tomorrow.
Everyone's dreading Monday, right? Monday's coming. And so anyway, it's birthday, I think spring. End of the year, I think, is also pretty common. And that's sort of the angle I'm taking right now is, here we are. I know of a handful of folks that are retiring right now, right at the end of this year, and some that retired end of November and have some vacation pay, some built up PTO that's going to carry their pay through the end of the year, but they're done right now. And it just gets me thinking, guys, we've helped people retire when the market's roaring, during challenging times and everything in between. Well, right now, you'd probably categorize as challenging time, uncertain time.
Yep.
So with everyone just having the normal question, well, do I need to change my investments? How should I invest during this time? I think that has an exclamation point next to it if you're retiring. How should you invest if you're retiring? Now, there's an overarching structure, a planning structure that fits great right within your financial plan. And that's the structure that we'd recommend to our clients and we'd recommend to you. Let's break it down. It's called the personal pension plan.
Yeah, so essentially what we've done over the years is we've kind of taken some of the best practices from actual pension companies, which if you think about a pension company, This is an entity that was created to pay out income for the rest of your life. If you qualified, if you worked for an employer who had one of these pension plans, the beauty is it's a stream of income that you can't outlive, right? And that really is what everybody wants when they're going into retirement. It's the number one fear that people have as they're entering retirement. What if I run out of money?
Yeah.
Right? What if this income, I can enjoy the early years, but then afterwards I run out of cash and then things get real scary, or I become dependent upon my family or something like that. And so this idea of creating an income stream that will last as long as you need it to last, that's the spirit behind a personal pension plan.
And most people, when you think about pensions, you probably think of emotions. Oh, I didn't have one, or oh, that went away, or whatever. But if you actually think of, and geek out on how it works, I mean, yeah, there's a bucket of money. There's a pool of money that is assuring you and all of your, coworkers or whatever that you're going to get this paycheck, this month and one next month and the following and for the next 20, 30, 40 years, however long you live. And so how can you structure your own investment portfolio to have that same level of confidence? You have confidence your pension check's going to come in next week, next month, whatever. How can you structure your own investments to have that same level of confidence?
And that's hard to do because a pension, by its definition, it's providing an income stream to thousands and thousands of people. Some of those people are going to have a really short retirement, sadly. They're going to pass away early in retirement and the pension doesn't have to pay out for very long. Others are going to live longer than anyone ever expected. But these law of large numbers, you kind of average it all out when you've got a big pool. But when it's just you, the stakes are higher, right? And you have to be very, very intentional, very safe or protective in the way that you structure these things. And so what we've done over time is we've helped clients replicate in their own personal life essentially the approach that a pension company would do if you were creating your own. And we break this into 3 separate buckets of money, not to be confused with the 3 bank account system that we talk about on the show a lot.
If you combine those, you ever think, I'm just such a geek, right? Just how many buckets to have the right structure and operating system for not only your present financial position, but then your long-term savings. And I don't know, it all does fit together.
That's right.
So the personal pension plan, and Kevin, I think we keep cutting you off here, but the big premise is invest based on when you need the money. Invest based on when you need the money, because that will help dictate how much risk you should take and how much money should be allocated where, and give you tons of confidence, especially during uncertain times.
Absolutely. And the interesting thing is when you think about a pension right now, it's less than 20% of the population has a pension. Yep. And really, if you're probably 45 or below, you probably don't have a pension. Some certain entities still do, but this is something that they're trying to address in Congress with the Secure Act 2.0, and there is an awareness of the coming retirement crisis, and so because I think it's interesting as I've been sitting here listening to you guys talk and trying to get a word in edgewise, you think about it and it's like, well, you're talking about generating income, and how do I generate income? And what are the sources of income that I'll have in retirement? But one of the ways, so there are 2 ways to approach it. One is from a income that I will have, and the other way is expenses that I won't have. But for now, at the risk of adding another bucket to the several buckets, no, I think that right now, if we look and you say the first bucket is a short-term bucket, everything's changed. Everything has changed.
I would argue everything's changed in all 3 buckets, if you will, right? The market has had this drawdown. That's so in interest rates have sort of come back. All right, before you even start laying out the buckets, you have to have this connected to your overall financial plan.
For sure.
Right.
I don't know how you can do this if you're not doing financial planning. Let me say that differently. I don't know how you can retire with confidence if you're not doing comprehensive financial planning. Because before you start talking about any buckets or what investment tools you should use, which we're going to give you a full update here, the remaining of this show, you've got to start with what's your retirement lifestyle? So how much will you be spending each month, and then non-monthly expenses as well. And then what income sources will you already have? That is, sort of basic story problem that I enjoyed when I was in elementary school. You might not have, but that then tells you the difference. Here's the income need that we need to come up with. And that then feeds the rest of the equation and the rest of your investment solutions. We're going to pick that back up. But then, like I said, bucket by bucket, we're going to tell you the world is different right now. Investment tools are different. Which investments fit? How much should you have in each? We're going to help you with all of that and more coming up on the Wise Money Show with Korhorn Financial Group. Hello, YouTube. Thanks for being here. This is the Wise Money Show. What you're watching right now is our weekly 1-hour talk show that airs right here on this channel, 10 a.m. Eastern Time every Saturday morning, also on podcast, but yes, also on a couple local radio stations, which is why the content's broken up the way that it is. If you're looking for more palatable or shorter videos, content directly applying financial wisdom to your life, we've got that as well. All throughout the work, we've got next wise step videos that take one financial concept and kind of bring it to life for you, tell you what you need to consider and some perspective and all of that. So make sure you hit that subscribe button, turn on notifications so you're made aware every time we drop new content. And if you like the content, thank you very much. All right. I don't know if there's more to say with that. The first step is figuring out, well, what's your income need? A different way is how much income can it generate?
You're right. Can I live off of what my portfolio is capable of creating for me?
Yeah.
And it's kind of circular, right? Like you might have an ideal of what you want to live off of, but then you find out reality is, my nest egg is only capable of doing this for me. Mm-hmm. I've got to make adjustments on my spending. Mm-hmm. So it's both, really.
Can we pick that back up and say it succinctly and then get into bucket one? Do you think you can?
Probably not.
Probably not.
We'll see.
We'll try. All right. If you're looking to retire right now, right now, or in the next quarter, since Kevin said a lot of people retire in the spring, I would agree with that. How should you structure your investments right now so that you have confidence taking that step away from the steady paycheck? We're helping with that right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name is Mike Bernard. With me in the KFG studios, Kevin Korhorn and Josh Gregory. Every episode of the Wise Money Show is on podcast, wherever you listen. Search the Wise Money Show, subscribe to it there, or follow us and rate the program. We appreciate that. All right, I think a lot of people do retire around the end of the year. Makes sense. It's a natural kind of resetting. Some, we said, there's another popular time is springtime. You get into the new year a little bit. Maybe you get your profit share or a bonus or whatever was expected or planned on, and you get through some of the crummy winter months if you're in the Midwest, and then you've got spring and you retire then. Either way, we're in the midst of great financial uncertainty. So how can you retire with confidence? It's the personal pension plan. That's something we've, created here to help our clients with, and it's connected to your overall financial plan. It helps guide your investment decisions at retirement. So you got to start with figuring out how much you need to draw from your investments, and you got to marry that with how much does your investment portfolio, how can it sustainably provide an income.
Yeah, exactly. I mean, you were describing in the last segment that this is part of financial planning. Your retirement projection is created to help you figure out what is that lifestyle that I want to be able to enjoy when I get out there to retirement. And Mike, you said take inventory of what the income sources are that are going to be coming through. And inevitably, for most people, their lifestyle is much bigger than their known income streams, right? Like they're going to have Social Security. Some people have a pension of their own. Some people might work part-time, that kind of thing. But usually that's covering part of their spending in retirement. Mm-hmm. And it's the gap there between what your income streams are and what you are hoping to spend that you're trying to solve for. And if you get started on that type of planning early enough in your working career, you can build a nest egg that will help cover the gap, the shortfall, right? You can help replicate your paycheck this way. But those of you that are already approaching retirement, unfortunately, what's built is built. If you're like already in retirement or you're on the eve of retirement, whatever you've accumulated, now the question is, how much can I afford to spend? How much can I afford to draw off of this? You may not be able to fully replicate all of that lifestyle that you wanted. And so your story problem, as you said earlier, is figuring out what is my portfolio, my nest egg actually capable of generating for me, and how do I find a great way to live off of that?
And then hopefully there's balance between those two. There's harmony, that your portfolio can provide the income, the supplemental income that you need. All right, you've done that math. You figured out, here's how much I need to draw in order to, have the lifestyle that I want. And it turns out that's the exact number, or that's the right number. Your portfolio can support that. So then what's bucket number one? How much money do you put in there? And then right now, with everything being different, what do you invest those dollars in? What do you do with those dollars?
I think of bucket number one as a paycheck simulator. When you were working and earning a paycheck every 2 weeks or a couple times a month, you had money that was just faithfully, dependably landing in your bank account, and you could budget off of it. You could live life. It was a routine that you really figured out, right? And then you get to retirement, and one of the number one questions that people have as they get into retirement, they know, well, okay, Social Security is going to make a deposit into our account once a month. That's different than what we're used to. How do we access the rest of our money?
Yeah.
And to me, the more closely that you can replicate or simulate what you were used to in your working career, it's going to make the transition into retirement just a little bit more comfortable.
And I think that also, if we're trying to, if the premise is how can you retire with confidence, having a paycheck, whether you want that every other week or once a month, typically your Social Security is going to come on a Wednesday based on the day you were born. Mm-hmm. And a lot of times people structure their investment withdrawals a couple weeks off of that, so you've got income sporadically throughout the month. But replicating that paycheck is what helps you have confidence in retirement. It's a steady income.
That's right. So if this first bucket is really like the faucet that's going to be dumping money into your bank account system, then this needs to be some very liquid, very safe cash, essentially, that you don't have to wonder, is this bucket fluctuating in value? Is it at risk in the market or anything like that? No, this is the safe money that's setting aside, ready to be paid out to you. And you can have confidence then that the next, say, 2 to 3 years worth of your income is covered.
So just more directly, figure out how much money you're going to be drawing out of your portfolio each month. Multiply that by 24 or 36. So you've got 2 to 3 years worth. And that should be bucket number one. Now, if you're just transitioning into retirement, there's typically the pent up big expense, whether that's a Jamaican trip or a new car, or we're finally going to update the kitchen or something like that. You want to consider that as well. But those dollars, doing that math, you should have 2, maybe 3 years worth of cash, worth of withdrawals in that first bucket. Now, what's interesting is since 2008, and we can't show you this chart, but 2008 is when money market interest rates stopped being pegged with inflation. If you go back throughout history, money market interest rates were at inflation or slightly above on average. And in 2008, that's when and I'm going to get on soapbox, guys, just rein me in. That's when we started shifting to modern monetary theory, which has blown up, by the way. And we started printing. And at that point, interest rates went rock bottom, even though inflation, before right now, was still 2-3%, something like that. So for a long time, that money market, that cash, you've probably felt like, okay, this is a waste of money. These are lazy dollars. And because they're there to provide liquid income to you, we would argue, no, they're not. They're not lazy dollars. But right now, you can actually get 3.5% on those dollars, and you want to make sure that you're getting that.
Mm-hmm. Yeah, and it used to be, just a year ago, if you had a bunch of cash and you wanted to be aggressive but not careless, and you had a mortgage at 3%, remember those days?
Oh, yeah.
Mm-hmm. Yeah, you'd say, well, hey, I can get a guaranteed 3% if I pay down my mortgage. And we're finally starting to get back to the days of saying, well, wait a minute, your cash is actually generating almost as much as your mortgage pay, your interest rate on your mortgage.
So here's the thing. So guys, and this is not individualized advice. These are ideas. You got to work with your CFP to get individualized advice. I wonder right now, in that first bank account, in that first bucket, if you will, you keep 1 year in money market. That should be paying about 3.5%. But then that second year, you put in a 1 year CD. And maybe that third year, you put in a 2 year CD, something like that. That's going to pay a little bit more than your money market. Now, if interest rates are still marching higher, which I think they will, you might be locking in an interest rate that maybe could be a little bit higher a few more months from now. We don't know. But I would consider leaving 1 year of it in liquid money market and then having a 1 year CD and a 2 year CD.
Yeah, that 1 year portion that you're describing is going to be paid out to you on a monthly basis or maybe every other week. But over the course of the next 12 months, you're going to spend it down to nothing. And right around the time that you're running out of cash in that bucket, good news, that 1 year CD is maturing and now you reload the payout portion. And now you've got year 2 funded. And right around the time that runs out, the second CD is coming due. And so it's creating a little mini CD ladder, essentially. And if you knew that you have 2 to 3 years worth of cash, then that does wonders to just kind of dial down the stress level or bring your blood pressure down every time you open up your investment statements. And that's one of the key functions, is the confidence to know that your liquid needs are met because you already planned ahead for the next 2 to 3 years.
Let me just give you 2 quick stories. 2008, Jim Cramer gets on the Today Show in the middle of the meltdown and says, sell, you need, what did he say, 2 years worth of cash, blah, blah, blah. Our clients we were serving, they already had that. That in 2020, when they finally announced, hey, we're shutting the economy down, blah, blah, blah. Oh my goodness, markets dropped 34% in just a couple weeks. If you were retired in following this program, yeah, you were a little worried about the long term, but you had enough cash in the short term. So that's the confidence that you need. Now, what's bucket number 2? What's the purpose? How much do you have in there? And what about bucket number 3? We've got that and more coming up on the Wise Money Show with Korhorn Financial Group. All right. You guys look at this inverse Jim Cramer ETF. Have you heard about this?
Do the opposite of what he declares.
It's not just do the opposite. They made an actual ETF for it.
That's amazing.
You can invest in it. I believe they've already made one that tracks Congress as well. Not the opposite, but doing actually what Congress does.
So just do what Paul Pelosi does. I mean, you want to talk about making some serious jack?
Right.
That guy
I know.
has done very well for himself.
It's so interesting. I haven't really dug into those, but it's very interesting. All right. Second bucket.
Congress wouldn't have any insight as to what to invest in anyway.
Right.
Okay.
Yep. All right. Here we go. Third segment. What's happening in the markets right now obviously has been scary, but it also does provide an opportunity if you're looking to retire for that bucket number 2, that second bucket in your personal pension plan. We're helping with that right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name is Mike Bernard. With me in the KFC studios, Kevin Korhorn and Josh Gregory. Stay up to date on all Wise Money content. Find us online, wisemoneyshow.com, and then all over social media. Wherever you are, we are there as well. The big question right now is if you're retiring in the near term, if you're retiring at the end of the year, if you just retired, you're retiring in the first quarter, amidst this, chaos, financial chaos and uncertainty, how can you retire with confidence? That is all part of, it's all kind of the solid foundation is your comprehensive financial plan. But you've got to have a certain investment structure to be able to retire with confidence in uncertain times. And that's the personal pension plan that we help people with. It's 3 buckets, coincidentally, just like the 3 bank account system, but it's 3 buckets. Bucket number 1, we just hit. Bucket number 2, what's the purpose? How much money do you have in there? And more importantly, guys, what are the investment solutions? Because I think they're better today than they were a year ago.
Yeah, so the second pension bucket is meant to be an income generator. And not the paycheck simulator that we were talking about in the last segment, the one that's going to just pay money directly to your bank account. This is actual investments. It is investments that provide some sort of assurance that you know you're going to have the value you need to cover 5, 7, as many as 8 or 9 years on top of the 2 to 3 years we were already talking about earlier in the show here.
Yep.
So the types of investments that a lot of people will use are things like individual bonds or individual CDs. There may be some fixed annuities that you can purchase where you're guaranteeing yourself. And yes, we use that word guaranteed sometimes. There are only some investments that you can use the G word with, but those that offer you an assurance that it's going to be worth a certain amount of value and it's going to pay you a certain amount of interest, it is predefined as soon as you go into it.
And we talked about in that first bucket right now, and this isn't always the case, but right now you can have your 1 year worth of need in money market and then a 1 year CD and then a 2 year CD, sort of like a CD ladder. This sort of continues now in bucket number 2. And previously, guys, you couldn't like it's really since 2008. Bucket number 2 has been a dud.
Yeah.
And it's led many financial professionals to say, well, have just a smattering of bond mutual funds and some, low risk stock funds because that's going to provide, a better future rate of return because you just can't get income anymore. Yeah. Well, now that's changed. You can actually build out a bond ladder. And if you're thinking, well, okay, for example, I need 50 grand a year. You could put in this bucket number 2, I completely agree, Josh, you're looking at 5 to 7, maybe 8 years of income there or cash there, and you're buying a 3-year bond, a 4-year bond, or fixed instrument, something like that. So it's paying a little bit more. You can probably get 5 to 6% right now per year. And if interest rates continue to go up, you might miss out on a little bit of that. But we know at some point interest rates are going to go down. Mm-hmm. And you could be locking in a very strong interest rate right now, along with a maturity where those dollars free up right when you need them to replenish bucket number 1, and along the way earn 5.5%, 6%.
That's exactly right. And I'm glad that you pointed to the fact that this second bucket, its sole purpose is to keep on feeding bucket number 1. Because as you live further and further into retirement, you're going to start spending down that safe cash that you set aside in your paycheck simulator, and you got to replenish it so that the faucet doesn't run dry at some point. Mm-hmm. So these individual bonds or individual CDs, these fixed annuities, those types of products, I'm just throwing some names around here. And these are the types of tools that you may want to have a conversation with your certified financial planner. Do they play a role in funding your retirement? And the thing that I like about the individual bonds is you have a defined date when those dollars are going to mature, when you're going to get paid back. It's essentially like you made a loan to the government or to a municipal government, local government. Maybe it's to a corporation, that sort of thing. But at a defined day, you're going to get your money back, and along the way, in the meantime, you're going to receive interest. And even if those bonds fluctuate in value, they'll go up and they'll go down, you already know ahead of time what you're going to get at that maturity. So it is a predefined outcome for you. You know that money's going to be dumped back into liquidity. It's going to go right back into that paycheck simulator, and you keep the faucet running long term.
And so why would you revisit it right now? Is because all of that has changed.
Yeah.
So, and Josh, it's interesting. You used the G word, which was guaranteed, and you used the A word, which is annuity. And those are both can be 4-letter words in our industry. You have to be really careful about them. But I think there's a lot of maybe confusion or misconceptions about annuities. And we say, look, about 85% of the annuity universe we wouldn't touch and we wouldn't recommend to our clients. But this idea of having something that's going to mature at a certain point in time. For instance, if it's a bond, now what's the problem with a bond? If I bought a 4-year or 5-year bond and interest rates go up, I'm going to watch the bond price go down, and it might hurt my feelings, especially if I'm thinking, wait a minute, this is my safe, steady, predictable, guaranteed kind of, It might be, if it's backed by the federal government, you could almost say, you might say risk-free return. I think there's always risk in whatever you do. But with the reason why you might want to be looking right now to set these things up, because as you look at something that is a lot like a multi-year guaranteed annuity, it's the stable value fund in your 401k. Look at what that thing's paying right now. The stable value fund in your 401k is probably paying 1.5% to 2%. And why is that? Because it's got a guaranteed insurance contract in there with bonds that are very low interest rate bonds.
Yeah.
Versus I'm 1.5% in my stable value in my 401k. I go out and shop in the open market today, and I can get a 5% on a 5-year multi-year guaranteed annuity. And people are like, well, wait, what's the difference? And it's about 3.5%.
Yeah.
But
why is the difference? How about that? No one says that, but I think
right.
That's what they mean.
The difference is because interest rates. So this is the worst year since I think 1783 for bonds.
The ratification of the Constitution. Isn't that crazy? See, it's the worst year in the bond market index because they're really, we just made up the bond market index. Not we at Cohorn Financial Group, but I mean the financial world just made it up. I mean, because stocks are, perpetual. They will continue. Bonds have a maturity. So how's their bond index if everything's always turning over? So yeah, they kind of made it up. But since they made it up in the 70s, by far the worst year in the bond market ever right now. But if you look at in general bonds, going back to the Constitution, that's insane. But yes, things have changed. The reason why it's such a bad year in the bond market is because interest rates have been pushing higher. So if you're out there retiring right now and you're looking and saying, well, I've got to fill out this personal pension plan. Oh my goodness, there are great deals.
This is one of the reasons why even when you're in retirement, you need to keep on learning more and more about the investment world, because you need to understand how bonds work and where they fit and where they don't. And that, to me, the knowledge and the understanding that, interest rates might keep on rising, and if they do, it's going to make those bonds I purchased get cheaper and cheaper or feel like I'm losing money in the short term. But if you know and you understand that it doesn't matter what it's worth along the way, the maturity date is already predefined. You know what's going to be dumped back into your hands, I guess, as far as cash goes. You don't have to worry. You don't have to stress over watching these investments fluctuate along the way.
And if you're thinking, well, wait a second now, so this bucket number 2 of the personal pension plan, let's say I've got a bond or CD ladder or something like that. You wouldn't use CDs, you'd bond ladder. Well, if I need 50 grand today, well, the 5 years out, it's going to be more than 50 because of inflation. That's right. That's why the interest rate is so important. And yes, these interest rates that we're sort of excited about, they're not keeping up with today's inflation, which is, the previous 12 months. But when you project out over the next 5 years on average, my goodness, I would hope 5-6% should match inflation, if not exceed it. That's the opportunity today. Yes, it's challenging, but that's the opportunity today if you're looking at retiring. Now, what about that third bucket then? We've talked about bucket number 1. Bucket number 2, now what's that third bucket? How much is in there? We've got that and more coming up on the Wise Money Show with Cohorn Financial Group. All right. Very thorough.
I was going to say, did you intend to hit
no.
one bucket per
I sort of thought we'd
segment?
be done with this in one segment. We are talkers.
Oh, my.
So, and again, just sort of apologize to YouTube. Thanks for hanging in there. It has more of a podcasty feel than a video.
That's right.
Yeah. So, all right. Lindsay, maybe you can edit in some really visually stimulating stuff, like maybe like an asteroid game or something like that. So people are entertained slightly while we're talking about this stuff. All right. Here we go. 4 segment. So third bucket and then tying it all together with financial planning. If you have, we'll get into a few different things. So, all right. Thanks for being here. This is the Wise Money Show with Korhorn Financial Group. My name is Mike Bernard. With me in the KFG studios, Kevin Korhorn and Josh Gregory. Every episode of the Wise Money Show is on the YouTube channel. Go check it out. I know the content is lengthy for YouTube, but every show is there. But on top of that, every Next Wise Step video is there. And those are videos that take one financial concept, apply it directly to your financial life, 8 minutes, 10 minutes, something like that. And they air all throughout the work week. So if you're, I guess, think about this. If you're looking for maybe one concise message a day about a financial principle or financial concept, go there. Go to the YouTube channel, search The Wise Money Show, subscribe to the channel, and turn on notifications so you're made aware every time we drop new content. All right, we are talking. I mean, guys, this is wisdom. So everyone's asking, what's going to happen with the market? What should I do with my investment? Should I make changes? But it's even more important if you're looking at retiring in the short term. How should you structure your investments if you're looking to retire right now or in the near future? It's actually more attractive today than it was even a couple of years ago, and that's implementing the personal pension plans term we've made up. It's a structure and a guide for making investment decisions that support your retirement and help you retire with confidence. We've hit bucket number 1, we'll review that, and bucket number 2, we'll review that too. But guys, let's get into bucket number 3.
Bucket number 3 is what a lot of people think of when the term just investments come up in general. It's more of your long-term growth portfolio. And I really emphasize that it needs to be growthy. This needs to be where you're taking more of the long-term risk, because if you think about, if you think back to the first 2 segments, hopefully you've been with us and you heard us say that the first bucket, the first pension pool of cash is just that. It's cash. It's money that's going to be paid out to you over the next 2 to 3 years. It is liquid. It is safe. You don't have to wonder what's happening with that money. It's just standing ready to be paid out to you on a monthly or a semi-monthly basis. The second bucket is funding the next 5 to 7 years. And essentially, we're saying, give me investments that have guarantees or assurances or predefined outcomes attached to it. Things that don't fluctuate as wildly. They are more income generating or interest earning types of investments, so that you can keep on feeding that first bucket we talked about. But then if you now know that you have covered the first 3 years in cash and the next 7, let's say, in safe investments, that gives you a decade before you need to sell any investments that are more growth-oriented and maybe tied more closely to the stock market, real estate markets, that sort of thing. Investments that can fluctuate, they're on much more of a roller coaster ride, as we have seen here in 2022. But the point is, if you can stomach the roller coaster ride, the growth trajectory, the growth potential of those types of investments is so significant. This is really where all the magic happens. This is how you stay out ahead of inflation, by getting enough growth that you can fund a more expensive future, is the idea.
Yep.
But you can't do that without subjecting yourself to a little bit of fluctuations and taking a little bit of risk and giving yourself a shot at true growth.
So here's the big idea. Bucket number 1 is about stability and, liquidity, where you're drawing money every single month or every 2 weeks. That's your paycheck. Bucket number 2 is for income, and ideally that income is keeping up with inflation. Bucket number 3 then is designed to beat inflation over the long term. And what does that? Well, in the short term, who knows? Over the long term, there's been one thing that's proven: to beat it handedly, and that's stocks, okay? So that's, again, like Josh mentioned, the average person has considered at some point this year, gosh, should I get out? Should I sell some of my investments? I'd be lying if I didn't think that as well, okay? But if you knew, well, listen, I'm in retirement, the next, 2 years or 3 years I have just in cash, and I've got a plan for where the 5 to 7 years after that will come from. Maybe you're less tempted to say, gosh, I might need to sell some of my long-term investments today. No, you've got a lot of time to let those things ride up and down. And when you look at, short term, it's very likely stocks remain volatile as we try to navigate inflation and money tightening and all this sort of stuff. Yet at the same time, when you look at valuations, they're not cheap, but they're much cheaper. And therefore, you can hopefully have patience and let those dollars rebound because you know you're not going to need them out for the long term.
And that is exactly what you're trying to create for yourself. It's resiliency with emotions. It's the ability to be patient. Remember back, so those of you that are in retirement right now, remember the days that you were working and earning a paycheck and contributing to your retirement plan at work, let's say. And back when you were working and we encountered one of these bear markets where the stock market just feels like it's only going in one direction and it's the wrong direction. Back when you were working and earning a paycheck, you were patient through that. It maybe drove you a little crazy and you said, oh man, my nest egg is shrinking. But you always would say to yourself, okay, I know there's time for this to bounce back.
Right.
That's what you're trying to recreate for yourself in retirement. If the first two buckets give you time, if you know you've got a decade before your nest egg, the growth portion of your investments are going to be called upon to help fund your life, you have time to be patient. You can remind yourself, or your certified financial planner can remind you, listen, these are not the dollars that you're going to be living off of. They will bounce back. Every bear market has been followed by a bull market that brings great recovery and then awesome growth on the other side of it.
Right, and if for some reason, because the three deadliest words in a market like this are, it's different this time, and so you want to be really careful.
Wait, I need to count.
But here's the thing: a lot of the people that have money in their longer term investments, they're looking and it's just not a great year, and it's a little bit discouraging. And what they need to remember is that this money is not, for some folks, there's a decent chunk of this money they're not going to get to in their lifetime. Mm-hmm. And so this is the money that the kids and the grandkids will be spending. So to leave this money on risk and let it continue to do what it needs to do. And I met with some folks, and they were concerned about how their portfolio had done, and their portfolio had done excellent on a relative basis compared to the market.
Yeah.
But when it's just you don't care about relativity. It's because it's absolute for you. And so they said, well, for me, from my experience, this is awful. And I said, sure, it is, no doubt. But on a relative basis, compared to what you might expect, it's done very well. Mm-hmm. And the great thing is she had read an article from AARP that they had sent out saying, hey, stay the course. And really what no one wants to hear right now is stay the course. Mm-hmm. Because they're like, well, I know you're going to say that, so tell me something else, or tell me something different, or let me somehow, be smarter than the next guy, or I'm missing out on something. What am I missing? No, you're not. The best way to do this is to not sell and make generational wealth mistakes in a time like this.
Mm-hmm. That's good.
And it's sort of like, going back a couple months ago, the big hurricane in Florida, right? There were some that just got rain, and there were others that your house is destroyed, right? And so it is relative and all of that. And yet, going back to the markets, if you look at history has always shown that, well, the future is uncertain, but the markets, those bear markets, Josh, are relatively brief compared to bull markets, these expansions that are three times longer, right? Mm-hmm. So giving yourself that patience and that, calm, that perspective with even at retirement, that's where the magic happens. So work with your CFP, right? This is all connected to all 6 areas of your financial life. Yeah, this is investment planning, connected to your retirement plan. You've got to make sure that these withdrawals from your investments are sustainable and that you won't run out of money and that you'll be able to live the life that you want. That's connected to your present financial position. What are your income sources? What's your lifestyle? What are some of the other big short-term financial goals that you have, buying vehicles, paying off debt, that sort of stuff? It's all got to be connected, and certainly connected with your health insurance as well. Your CFP can help. All right, that's all the time we have for today. On behalf of Josh Gregory, Kevin Korhorn, the rest of us at Korhorn Financial Group, have a great weekend. We'll see you next Saturday for the Wise Money Show with Korhorn Financial Group.
Securities offered through Silver Oak Securities, member FINRA/SIPC. Advisory services offered through KFG Wealth Management, LLC. Doing business as Korhorn Financial Group. KFG Wealth Management, LLC and Silver Oak Securities Incorporated companies are unaffiliated.